And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast today. So, what are we seeing today? Well, yields again. Yields are so important because yields tell you the direction of the stock market. And when you have the 10-year yield like this morning, first thing, the 10-year yield started out very high this morning. And then maybe about an hour into trading, the 10-year yield started to drop. So you know you have to start buying tech because you know tech stocks are going to go up. And you start buying the tech stocks and you start selling the defense stocks. Just like when oil goes up, you start shorting airlines, okay? And you buy oil services. But everything is tied to yields. My whole career, 50 years, I watched two things like a hawk. The yields, or three things actually, the yields and IWM, the small mid-cap stocks. Because IWM tells you everything you need to know. It's never wrong. It always tells you when you're going to have the crashes. It's always on. The last 5 crashes been right on. IWM tells you all that information is so important. It gives you a comfort level. IWM is never wrong. But I watch also yields. So yields, IWM, and margin debt. So yields, IWM, and margin debt. Wall Street won't tell you that. They don't want you to do that. Because if you watch those 3 things, you'll be a good trader. They don't want good traders. They don't make money off good traders. They make money off terrible traders who don't know how the market works. So when people ask me, why is it that I watch margin debt? Because think about it. It doesn't tell you what investors are thinking. Okay, it tells you how fast the machine is going to dump the stocks. Now, machines, what's a machine? Is it a computer? Yes, but it's the program they put into the computer. And that computer takes over when there is not enough institutional money. There's 12 big institutions that manage $50 trillion of all the money that's in Wall Street. 6 of those institutions, the big boys, they're the ones that make the market go. They're the big managers, the big 6 guys. And they drive the market. So you have to follow the money, okay? And as long as you follow the money through yields, IWM, and margins, and when I say follow the money, I'm talking about not turning on your TV and listening to these dopes. Okay, buy, and all this stuff. No. You follow the trend of money, and you follow the pattern of money. These 6 institutions, when they buy stocks, they leave a footprint behind. So you can actually know what stocks they're buying and what stocks they're selling. That's what's important. But going back to margin, our margins right now are historic 1.4 trillion. Once again, that's what it was in 2000. And that is what triggered the dot-com crash. So when people ask me why I watch margin debt so closely with my yields and IWM, margin debt, it just gives you a comfort level. You know exactly when these machines kick in and take over, when the institutions are out, like right now, that's what's going on. In 2000, margin debt turned into a huge bubble, into a crash. Now, nobody's talking about that today. They don't want you to talk about it. They don't want you to get scared, okay? I'm not trying to scare you. I'm just trying to tell you, you just watch the margin debt. And when it's this high, and it's historic, these machines are the problem. They kick in. It was the machines that gave us the dot-com crash. It wasn't really investors. It was the machines that kicked in because the speed at which they start dumping is incredible. So 1.4 trillion. As I said, the last time we saw that was in 2000, 2001. And the NASDAQ dropped 78%, and we wiped out about 6 trillion in value of our stocks. So watch yields, IWM, like a hawk, and you'll be fine. Now, margin debt blows up markets, okay? It blows up markets. And margin debt is really simple. People borrow money to buy stocks. You talk about something dangerous. People who go in and they let's say they have $10,000, okay, and then they can margin it up 4 times that, right? So dangerous, so dangerous. So people borrow money to buy stocks, and when stocks go up, everybody's happy and everybody's brilliant, how brilliant they are. But when stocks go back down, guess what? The brokerage house wants their money back, no excuses. And that's when trouble starts. Because margin debt, as I say, is near that same level it was back during the dot-com days, back near 2000. Back then, margin debt was 6.2% of the money supply of M2. It's about 6.3%, it's about 6.2% today. And high margin debt means that markets are so leveraged, so fragile, but Wall Street won't tell you this. And you're just one bad day away from getting crushed. Now, I'm not here to scare you. I'm not telling you the market's going to crash, okay? One day it will. Right now, there's only a dozen stocks, really 6 out of a dozen stocks holding the whole market up. But now we got margins holding up the market. So in 2000, when the dot-com bubble cracked, margin calls hit. It's unbelievable, okay? You can hear screaming going on, okay? When those margin calls hit, the market's like a set of dominoes. You ever see those? You hit one, they go, it's unbelievable it happens. And nobody's talking about that today. Nobody. They don't want you to know this. So selling's triggered, right? And more selling's triggered. Prices fall, okay, faster than traders can react because of the margin calls. Here's the problem. The machines take over. And when they took over in 2001, the NASDAQ dropped like a flying crowbar. 78%. They couldn't stop it. The velocity was incredible because once those margin calls start, it's like a cancer spreading, and it's just unbelievable what happens. And it's not because suddenly everyone hates tech stocks, okay? But because everyone was over leveraged back in the dot-com days. Today, it's the same exact thing. We have not learned. People are so over leveraged, but they always look at and listen to every day. We have an all-time new high, every day an all-time new high, which is a bunch of BS. Bunch of BS. If we didn't have the margin leverage, we wouldn't be having those all-time new highs. We're building our own crash. So every time you hear, wow, did you see this? Another all-time new high. Yeah, the market's up 30%. Everybody goes nuts, right? Especially Washington. The market's never seen this. The market's so strong. The stock market has nothing to do with the economy, the strength of the economy. Learn that. Every day on TV, Washington, they stand up and say, look at the 401ks. They're up $30,000. No, they're not. They're about an average of 9,000. The market doesn't tell you the strength of the economy. Small mid-cap stocks do, IWM. And because they don't tell traders this stuff, we end up back in the same trap. And that's where we are right now, the same trap we're in 2000. But they can keep propping this up for another 5 years. At least Trump can keep it propping up to the day he leaves office. But nobody's bigger than the market. Now, why today looks the same as 2000, 2001? Exactly the same. We have the same formula, the same record margin debt, high valuations, which are insane. The valuations are insane. You know, it was only a few years ago, 4 years ago, 3 years ago, stocks that were paying $75 for, right now you have to pay $450, $500 for. It's insane. So we have high valuations, crowded trades. AI is the biggest problem. AI is driving all the momentum. And the machines, computers, the program they put into the machines, into the computers, okay, they control 80% of the volume. So that the machine that took us down during the dot-coms day is again controlling today, not the institutions. The 6 institutions are not in the market. BlackRock's not in the market. Vanguard's not in the market. State Street, Fidelity, T. Rowe Price, they're not in the market. What do I mean by that? The money that they are managing, that 50 trillion, the money, their portion, they're managing, they're already in stocks. They're managing those positions, but they are not buying stocks anymore. They're managing what they have, but they're not buying stocks anymore. People don't understand how dangerous that is. Why? Because the volatility of yields. Look what happens every day. As soon as you see the 10-year Treasury yield go up, everybody's dumping tech. Next day, the machine sets it up. Now all of a sudden, yields are down. Everybody gets into tech when yields down. Everybody gets out when yields are up. And they always rotate from tech right back into defensive stocks like utilities and so forth. And it's just a joke. But this machine is involved because of the leverage we have. It's so huge. The same leverage we had back in dot-com days. So when yields rise or volatility spikes or a big tech name misses earnings, that's when you get the real crack. That's when panic sets in. And we're going to see that soon. Remember, 12 stocks are holding up the entire stock market of 700 stocks that are traded daily, the names that everybody recognizes. So the machines are programmed where they execute. The machines, they see leverage. They see it, and they see risk. And they cut positions instantly. They'll just cut. Just like you notice today, every time, like if yields go down and stocks go up or the banks go up, you notice how it doesn't hold the high of the day? It gives it all back. That's the machines. When institutions are in the market, and let's say your stock goes up in the morning from $100 to $110. When the institution market, it will hold near that 110. Today, when the market goes up from 100 to 110, take a look at your candlestick. What happens? It starts coming right back. Because the programs that are in machines, they're programmed to start selling once they're out of their buy tickets. Institutions will keep supporting that stock. Machines are programmed, once they're out of buy tickets, they start moving sell tickets. And that's why the market drops faster today than in 2000, 2001. It's going to drop much faster because machines don't wait for confirmation. They sell at the first sign of trouble. All these AI machines, they're smarter than humans. And that's why you're going to see such a travesty when this market crashes. I mean, it's going to be unbelievable. Remember, machines are programmed. And they turn margin debt, the 1.4 trillion, into a waterfall, a cascade of selling. Machines are programmed to protect capital. Understand that. They don't care. They have no heart, no feeling. This is AI. They don't care about stories. How all these jibber jabbers come on TV and they're always telling you a story based on some fundamental. Some CEO comes on. Hey, I'm CEO Joe Suckface and I manage 400 trillion gazillion dollars. Who the hell cares? The machines don't care. The minute these machines sense fear, bam. And when margin debt is high, machines tighten the risk model right away. If yields rise, bang, they cut tech immediately. If volatility rises, they cut leverage. If prices break support, they sell everything. They're programmed to sell everything because the program's tied to margins. If liquidity dries up, the acceleration is incredible. So we can talk some more about this, but what I just talked about, no one understands because Wall Street won't tell you. This is called forced liquidation. Ask any trader, do you know there's forced liquidation getting started here? Do you know that? Oh no, what's that? And then it becomes a self-feeding loop. Prices fall, margin calls start. Then you got machines selling. Then you got prices falling even more. Then more margin calls. And machines sell even more and harder. That's what happened in 2000. But guess what? 2001. We didn't have AI back then. We didn't have a machine programmed with AI. So anytime someone asks me, why do I always look at margin? You're the only one that talks about margin debt because that's what kills you. The margin debt forces that crack in the dam to open. IWM tells you what Main Street is really doing, how small businesses are doing. Those small businesses that create America with 1, 2, 3 employees. IWM is always right. When IWM drops and the S&P's not dropping and the Nasdaq's not dropping, believe IWM. It's telling you you're going to have a correction. It's never wrong. IWM's never wrong. Also, your yields are never wrong. They always give you direction which way the stock's going to go. And margins always tell you when it's over, when this big, beautiful bubble is over. Now, if you know how to sell short, you should have no fear. But Wall Street doesn't want you to short. That's why they scare you to death and talk you out of it. Because they don't want you on the other side of the trade. When everything blows up, they'll be there shorting you. They don't want you shorting them. So that's it for today. Then I'm not going to try to scare you. I'm trying to bring to you, get you to pay attention. Yields, IWM, small and mid-cap stocks, and margins. That's where the attack is coming from. We're going to go into a financial battle. And we have no tanks, no ammo, no defense, and there's going to be a battle starting, financial battle. And it always starts, the first attack is right there, right under everybody's nose, margin debt. That's what killed us in 2001. That will kill us again. See you on the charts. Join my gang, free for 10 days. philsgang.com.